Alright, greetings everyone. Welcome to this class. In this class, we want to illustrate the bank reconciliation statement format, mainly meant for accounting students and accountants. Most times, it is challenging for some students in having to prepare bank reconciliation. They sometimes get confused as to how the format is and how to actually present it. So having done your exam question, this information we see here are to be given. You get them from the questions. And for accountants, especially those who are working under manual process environment, this information you are going to get them when you have done your comparison between your own bank statement or your own bank cash book with that of the bank statement. So then this is how you do your reconciliation. So we start with the title bank reconciliation statement as at 31st March 2025. You may have the company name also above here. Then you have particulars, you have amount. Now you are starting with the bank balance as per cash book. You can as well start with balance as per bank statement. In any case, you are going to end up with balance as per the other book. So we start here with balance as per cash book. Of course, whatever balance you have in your cash book, you take the balance. And then you are going to add items credited in the bank but not in cash book. These are cash book adjustment items. If you are doing cash book adjustment, these are the items that you're going to use to do your adjustment of the cash book before you do the balance bank reconciliation proper. In here, this format is taking everything together. So we are going to add transactions like direct deposit by customers. These are deposit made by your customers into your bank account which you did not capture in your cash book. Some customers will make payments direct without actually informing the company. This is an example of such payment. We call them direct deposit. Next is bank interest or income. The bank usually pay interest income to the company for transactions, for bank transactions or for other reasons. They pay. This is interest income, not interest charges. So it is part of direct payment into the bank account of the company, which the company is not aware, is not notified. So it's not the cash book. So you add it here. Example of such direct payment again is something like dividends. The company can pay, the bank can pay dividend direct to the company account. It will be the company is entitled to dividend, from another company for investment, and then the company pays direct into the bank account of your own company. So you may not see it. It's also part of what will be added here. Okay, then having done that, having added all that is supposed to be in the cash book but not in the cash book that are in the bank statement, that is all the inflows that you did not capture in the cash book, add them here. These two are just example. Having added them, you then list items that are debited by the bank but not in the cash book. These are also cash book adjustment items. Example of this kind of items are payments. These are payments made by the bank. Okay, expenses incurred by the bank or expenses charged you by the bank of which you have not taken note of, you are not notified, so they are not in your cash book. Example is a bank charges. The bank will charge you directly for certain interests and other charges and fees direct into your bank account without your notice. So in your cash book you don't have it, so you have to bring them here by deducting them. Okay, they are to be found on the debit side of your bank statement. The next one is direct payment by the bank. These are also payment made by you, made for you by the bank. Maybe it's things like standing order. You may have given the bank standing order to pay certain payments for you from your bank account. So they don't notify you for such. Example is subscription. You may be paying subscription for a particular service a particular company is rendering to you. The bank will just pay for directly from your account without your notice. So such payment you have to bring them in here. You have to deduct them here. Another example is also dividend. Remember, we have dividend income, and then this one is dividend payment. Dividend payment here is if another company is getting dividend for investment they made into your company, and you are meant to pay them dividends every month. The bank may also be doing that on your behalf by way of direct or standing order. So this is what we mean by this direct payment. So this is also brought here and deducted. And then we have check, dishonored check or return check. These are check that has been issued but they were dishonored, they were returned on getting to the bank to make a withdrawal or to make withdrawal. These checks are returned for one or two reasons, mostly for lack of funds on the account. So having done the you may not know the bank would have debited you for this, and so you are not aware because you on your own you may have received the check as if you had to cash it or you had to deposit it into your bank, but at the end of the day it was returned, so you have to reverse the posting by minusing it here, okay, which the bank must have done on their own side. So you will have to do your own so as to cancel the transaction. Call it check dishonored or bounce check, return check. Then here ends the bank cash book adjustment. If you are doing a cash book adjustment, here ends the cash book adjustment. By the time you take the total of what was added, all of this place, including the opening balance, and deduct all of these transactions, you will be having your cash book adjusted balance, your cash book adjusted balance. If you are separating it, and then you now do your bank reconciliation proper, which will now contain these two, but in this case now they have been added together. So having done this, the next is you add checks issued but not yet presented. We call these unpresented checks that are not presented before the end of the period or the reconciliation period. They are checks that were issued and they have been issued. You have minus them from your book, from your cash book, but at the end of the day they were not presented to the bank for the bank to do the needful, so you add them back. They are called unpresented checks. And then you less checks deposited but not yet cleared. We call this also uncredited check. Uncredited check. These are checks that have been deposited, but they were not credited as at the time of reconciling the bank statement. Do you understand? The example of this kind of situation is a check for 30th, which 30th of a particular month, which at the end of the day have not been deposited before the end of business, or that has not been cleared by the bank. You have deposited it, but the bank has not cleared it as at the end of that month, that is as at that 30th. It will be cleared on the 1st, and so it did not reflect in on that period. So you have to deduct it. The same thing happens here. A check that has been issued but not presented before the end of the reconciling period will be. So having done this, you should have your balance as per bank statement. The balance you're going to have at the end of the day must be equal to the balance you have in your bank statement, which must be the same thing. This balance must be the same thing with your balance as per cash book adjustment, or as per cash book. So this balance must be the same thing. Okay, this balance is expected to be the actual bank balance, or balance as per bank statement, which must be the same thing with what you will have in your bank cash book adjusted balance. Okay, with this you're done with the reconciliation. So this is to help you understand the format for preparing the cash book. See you in our next class.